We have all heard of OPEC Plus and the high-profile production cut they just announced. But a lot of Americans are asking why OPEC Plus has gotten back in control of oil prices. What about U.S. oil fracking? What about the Permian Basin? What about all of that wildcatting that crashed oil prices back in 2014? Where is all of that oil production capacity when we need it most? Well, my friends, the days of the U.S. shale boom may be about to take off again. Banks have pulled back from funding oil and gas operations. And other traditional sources of financing such as equity investment are drying up. That includes the typical reserve-based lending facilities. But, a new kind of funding for oil and gas is now booming. U.S. oil and gas frackers are getting a booming market for alternative funding. That is the Proved Developed Producing, PDP, securitization. In PDP securitization, an oil or gas producer issues bonds in an asset-backed securitization, ABS transaction. In other words, frackers can use the cash from their oil and or gas production as collateral for the notes placed with investors. To me, this rhymes with mortgage-backed securities that preceded the 2008 Great Recession. And, as I now see it, this will be where the next bubble comes from. Shale fracking production is rising at a much slower rate than it did before the 2020 crash. And frackers have been slow to ramp up. But I predict that these new asset-backed securities will change all of that, starting in 2023. So, what does this mean for frackers? What does this mean for consumers? What does this mean for energy markets? What does this mean for oil companies? What does it mean for the U.S. economy? And what does it mean for the future of the United States? But, before we get into all of that, please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Shale fracking production rising at a much slower rate than it did before the 2020 crash. OPEC Plus recently cut crude oil production by 2 million barrels per day. Enter energy assets securitization. The first such energy asset securitization took place in 2019. But it has quickly gained popularity over the past year, as many private producers look to diversify their funding sources. Securitizations backed by oil and gas assets help diversify funding sources, said Fitch Rating. Fracking for companies that would typically access capital from more traditional sources, continued Fitch. Typically, this would be reserve-based lending, RBL, facilities, Fitch said. Or even high-yield bond issuance or equity investment, Fitch also said. This type of funding was brand new in 2020 and the pandemic hadn't crushed oil demand yet. The newly issued transactions provide stable cash flow, continued Fitch. Depletion rates are fairly predictable depending on the age of the wells and the overall diversification, Fitch also added. Even during the pandemic and the volatile prices in 2020 and 2021, oil and gas Proved Developed Producing, PDP, securitizations showed much less volatility, said DBRS Morningstar. This is largely because of commodity price hedges and structural features of the securitizations, DBRS Morningstar continued. PDP securitization financial performance remained resilient during the pandemic. This was despite high volatility in oil and gas prices and operator bankruptcies during the pandemic, Fitch Ratings said. Required hedges on a majority of production volumes limit the effects hydrocarbon price fluctuations have on expected revenues, Fitch continued. Additionally, PDP production has low break-even costs, as the majority of capex costs have been incurred, Fitch also said. But, the market for asset-backed securities is booming. Maybe we should all be alarmed by that. The oil and gas asset securitization market has skyrocketed this year. Investors have purchased $3.9 billion in PDP securitizations so far in 2022. Actually, the biggest securitized financing for a U.S. energy producer was done this year. That was a deal for $750 million securitized financing for natural gas producer Jonah Energy. Jonah is a Denver-headquartered oil and gas company. Jonah offered $750 million fully amortizing notes backed by a portion of its producing assets. Its assets and operations are located within the Greater Green River Basin in Wyoming. Jonah has over 2,400 producing wells. It has more than 130,000 acres in Wyoming. I'm pleased to have completed a long-term financing transaction, said Jonah Energy's president and chief executive Tom Hart. It completely pays down our RBL, Hart continued. It also positions us with a strong balance sheet, Hart said. Now we can pursue the significant drilling opportunities that we have on our acreage and strategic opportunities that may come our way, Hart also noted. Jonah Energies was the biggest asset-backed securitization completed to date, said Guggenheim Securities. Guggenheim Securities was the sole structuring advisor, book running manager, and placement agent of the financing to Jonah. This ABS transaction, which represents the largest PDP securitization completed to date and the third 144A that Guggenheim Securities has structured for the energy sector, said Anuj Bhartiya, Senior Managing Director in Guggenheim's Structured Products Origination Team. It reflects the confidence of industry leaders and market participants in the suitability of energy-related ABS in the market, Bhartiya also said. Pure West Energy successfully closed a second asset-backed securitization in August. Pure West is Wyoming's largest natural gas producer. That deal was for $365 million of asset-backed notes collateralized by a portion of Pure West's natural gas assets. Pure West's first securitization deal was for $600 million in November 2021. Pure West Energy expected to distribute the proceeds from the notes offering to the note-holding investors. Oil and gas securitization supporters say that they could be beneficial to both investors and producers. Investors have a relatively predictable cash flow profile of an oil and gas PDP, said energy attorney Daniel Allison. The rating agencies see production risk as a tolerable variable, Allison says. Frackers can use energy asset securitization for multiple purposes. They can diversify their capital structure. Or, they can tap this alternative market when others are less favorable, according to Allison. The days of explosive growth in U.S. shale oil production have been waning since the start of the pandemic. There is no federal plan on how the U.S. oil and gas resources could be used to increase America's energy security. Oil industry analysts have downgraded their forecasts of crude oil production for 2022 and 2023. Although they still expect U.S. oil output to increase to a new annual average record next year. But these projections have been repeatedly revised downward since the start of this year. The Permian Basin is the largest oil fracking area in the world. It is located in western Texas and eastern New Mexico. The U.S. shale patch is no longer the swing oil producer, said a top oil industry executive. OPEC Plus is now back in the driver's seat as the most important factor in oil supply fundamentals. Shale was thought of as a swing producer. The Saudis and OPEC have waited this out, the executive continued. The current state of affairs of the U.S. oil industry stand in stark contrast most of the past decade. Between 2009 and 2019, U.S. oil producers ran wild. The U.S. should pump more oil amid the world's energy crisis, said JPMorgan Chase CEO Jamie Dimon. OPEC Plus announced a production cut of 2 million barrels per day, starting in November. The United States is the swing producer, not Saudi Arabia, Dimon told reporters in an interview this week. The United States is teetering on the brink of recession. In my view, America should be pumping more oil and gas, Dimon told reporters. The U.S. is the world's largest producer of oil, Dimon said. But the United States is also the largest consumer of oil in the world. Dimon also predicted a recession for the U.S. within the next 6 to 9 months. For those of you not familiar with OPEC Plus, it is a group of some of the world's largest and most powerful oil-producing countries. OPEC Plus includes Saudi Arabia, Russia, Iran, Iraq, Algeria, Nigeria, and other oil-producing nations. It does not include the United States or Canada, two of the world's largest oil-producing countries. Crude oil prices peaked in June at more than $120 per barrel. But, fears of the prospect of a global economic recession have put oil prices on a persistent downward trend since then. And, high oil prices typically bring about demand destruction as people drive less when gasoline prices are higher. Energy analysts point out that it is difficult for anyone to predict oil prices 2 months in advance these days. The future of the economy and energy prices are highly uncertain. Prices reached a 2-year high in March. But oil prices fell 25% between the middle of June and the end of August. The price decline has been driven by the expectation that interest rate hikes by the U.S. Federal Reserve would reduce demand for gasoline. And by concerns that COVID-19 restrictions in China would slow the Chinese economy and reduce oil demand. Although gasoline prices are generally high in the U.S., they never really got as high as many consumers feared. The average price of gasoline in the U.S. reached a peak of $5.02 per gallon on June 14. Multiple forces are acting on worldwide oil prices. Concerns about China's economy are putting downward pressure on prices. High prices at the pump have simply been a cure, resulting in less driving by consumers. In the U.S., gasoline demand has dropped off significantly this summer, said the U.S. Energy Information Administration in a statement. But, what do you think? Please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.